Good evening, students. Welcome to the session. I hope you have revised the topic of capital gain and the very important topic what we were dealing in the last class on what? 45.4. Okay. So today we are going to progress with that because we have left it midway. Jacob, yes, I would explain the example for Rule 8 AB4. I would. Okay. I would quickly revise what we have done it till now so that, everybody is in sync and then we can go in the flow of the topic. Fine. Okay. So we were discussing about section 9B. One second. Yeah. We were discussing about section 9B. First, what is 9B? 9B is when the firm transfers the asset, capital asset, or the stock in trade on dissolution or reconstitution, then in that case, it will be deemed that the firm has transferred to the partner. It will be deemed to be the transfer and the income would be deemed to be that of the firm in the previous year in which the capital asset or stock in trade is received by the partner. Right? This is the income of the firm. Now, under which head it is chargeable? PGBP or capital gain in accordance with the provision of Act. And then it says that the fair market value of the capital asset or the stock in trade will be the full value of the consideration. Are we clear? So that is number one. Number two is 45.4. Number two is 45.4. Now in 45.4, what was the trigger point in 45.4? When the capital asset or money is received by the partner, right? So when a partner receives any money or capital asset from the firm in connection with the reconstitution. So here we do not have dissolution, here we do not have stock in trade. What we are having here is the money, right? So here we have only money and the capital asset. Then in that particular case, what will happen is that it will be deemed that there is a income of the firm. There is income of the firm. It will be deemed that the outcome would be that it will be deemed to be the income of the firm and it will be chargeable to tax in the previous year in which money or capital asset is received by the partner. Are we clear? So that is section 45.4. We have section 45.4 and we have section 9B. Under 9B, we had only dissolution on reconstitution, and then we had separately the capital asset plus stock in trade. Clear? Here we are having under 45.4, we have the money or capital asset and only the reconstitution. Are we clear? Now moving further with this, what did we see? What is the computation under 45.4? A equal to B plus C minus D. B is value of money received. C is the fair market value of the capital capital asset, and D is the capital balance as on the date of the reconstitution. You have to ignore the revaluation and self-generated goodwill. If the value of A is negative, you have to consider it 0. Clear? We have seen the distinction. Now, what did we see? We'll go example by example wise. That if I give the cash to the partner on account of the revaluation which is happening on the retirement, generally we consider the assets on the net asset value. Are we clear? So if there is, based on the net asset value, there is revaluation, I'm paying the equivalent cash to the partner as his share of asset, then 9B will not be attracted, only 45.4 will be applicable. So in that particular case, 9B is not applicable, only 45.4 is applicable. And now 48.3 provides that when this asset will be transferred, so there is a preponement of liability because the firm has not realized the gain on the revaluation. Firm will realize the gain when it will sell the asset. But the taxability is happening when the partner is realizing the amount on account of that revaluation, right? So to that extent, there is a preponement of liability in the hands of the firm. And therefore, in that particular situation, what will happen is the 48(3) will give you the deduction when the asset will be transferred. So when this land will be transferred, at that point in time, the amount which is tax charged under 45(4), which is attributable to this asset, will be allowed as the deduction. Are we clear? So here there was single asset, so there was no problem. Clear? This was example 1. In the example 2, what did we discuss? That the capital asset itself was transferred. So there would be 9B, there would be 45(4) both. Clear? For now, this is what you have understood. 48(3), as I said, if there are multiple assets, then how do we calculate the 48(3)? Then Rule 8B comes to our respite. Rule 8B comes to our respite. Also, 48(3) says that 48(3) deduction will not be available if A is 0 or if the tax is under 9B. Clear? Now, Rule 8AB, which is there, the sub-rule 2 is attribution and sub-rule 3 and 4 is the sub-rule 3 and 4 is the 1 second, I think. Are you able to see my screen? Are you able to see the screen? Yes or no? I hope now it is visible. Okay. Yes. So sub-rule 2 was what? Sub-rule 2 was basically my attribution rule. And sub-rule 3 and 4 are when it is not to be attributed. Are we clear? So sub-rule 2 is attribution. Sub-rule 3 and 4 is when it is not to be attributed. So sub-rule 2 says what? That when basically there is the single asset, then you have to attribute to that asset only. But when there are multiple assets, then how do you attribute it? So you attribute on the basis of the revaluation in that particular asset. So let's say there are two assets, X and Y, and both are revalued. And now the retiring partner is paid cash. Now the amount which is taxable under 9B is nil. What is the amount under 45(4) was 90. Now this 90 would be attributed between the two assets, 60, which is the revaluation in X, and 120, which is the revaluation in Y. So 48(3) will be allocated or attributed between the two assets in this particular proportion. Clear? Then sub-rule 3, which is there. What did sub-rule 3 provide? That in case the revaluation is not relating to a capital asset, but is on account of any other asset, which in our example was stock in trade. Stock in trade is not my capital asset, right? So the revaluation occurred because of stock in trade. So 48(3) attribution will not happen because what you are going to sell is capital asset. If there is no capital asset you are going to sell, then 48(3) doesn't come into picture because stock in trade will be under PGBP. Clear? The sale of stock in trade would be under PGBP. Are we clear? 8AB4. Now what is 8AB4, which most of you are asking? Let me tell you that. So let's say that there are two partners, A and B. We have one capital asset and we have the other asset. So 20 is the book value, 80 is the book value of other asset. Now on revaluation, the capital asset is revalued to 80. Now capital asset X is transferred to A. There will be 9B, 80 minus 20, 60, right? There will be also 45(4). There will be also 45(4). Are we clear? Now what will be 45(4)? 45(4) will be 80 minus 20. 80 minus 50, right? Here what Rule 8AB says that no attribution if the capital asset itself is transferred. No attribution if the capital asset itself is transferred. So 48(3) says what? that the attribution will happen to the remaining capital assets. Here, my capital asset itself is transferred to the partner. So 48(3) purpose is what? To provide the relief for the preponement of tax liability which has happened under 45(4). But here I have given away my capital asset. and there is no other capital asset. Now the capital asset which is given by me, when I'm transferring to the partner, I'm realizing the revaluation amount, right? So then there is no question of attributing 48(3) to that particular capital asset only. Had it been Y also a capital asset which had been revalued, we would have attributed to that. But here there is no revaluation in Y, and Y is not even a capital asset. Are you getting that? So where the capital asset is transferred itself, there you will not get any relief. Are we clear? Are we clear? Here also you will see that the double taxation is happening under 45(4) and 9(b). So double taxation is not avoided by 48(3). So for that, we have the CBDT circular. What is a CBDT circular? Let's try and understand that. Circular number 14 of 2021. What is this? Yes, Disha, hopefully. So what is this circular saying? Let's try and understand. Very important circular. And also this circular has a lot of examples too, which is what we are going to cover in detail, which will help you understand very, very clearly that what is this entire section about. This is a very complex section. No doubt about it. Are we clear? So circular number 14 of 2021. This is issued in accordance with section 9B. So if you remember, under 9B, power is given to the CBDT to issue the circular to clarify the application of this section. And in accordance with that, this particular circular has been issued. Are we clear? So now what does this circular provide? This circular provides the guidelines. What does it say? That under the circular, if you see, first thing they have clarified that there is a 48(3) which is there. 48(3) which is there is not removing the double taxation. So circular number 14 is providing for the alternative benefit. Then understand. Let me elaborate it. So 48(3) is not avoiding double tax. What 48(3) is doing is, it is giving you the relief from the preponement of the tax, which has happened under 45(4). And when you're selling off that asset, you will get that deduction. Because we have already taxed you under 45(4), we'll give you some deduction when you will actually sell that asset. So technically, when a capital asset is transferred in a reconstitution, there is 9B, there is 45(4). Both are becoming applicable. So there is a double taxation which is happening. Right? So how do we resolve that? For that purpose, we have the circular number 14. So before I tell you what the circular says, let me give you an example so that you are able to understand it in a better way. Okay. So, what does it say? Let's say there are two partners, A and B. The profit sharing ratio is 50-50%, correct? capital is 50 and 50. We have two assets, X and Y. This is a capital asset. This is others. The book value is 10 and 90. The fair market value is 80 and 90. Now A is retiring and capital asset X is transferred. Capital asset X is transferred to A. Clear? Now, what will happen in this particular case? Whether there will be 9B? Yes, there will be 9B. What will be my 9B? 80. Correct? 9B will be 80. Then minus, let's say, my indexed cost of acquisition for this X is, let's say, 30. So 80 minus 30, my 9B will be 50. Let's say tax on this is, let's say, 10. Let's assume. Right? What will be my gains in the books of account or book gains as per books of accounts? What will be my book gain? 80 minus 10. In the books of accounts, I will not take index cost of acquisition. Right? I will take the book value only, which is 10. So 70. 80 minus 10. In the books of accounts, we don't consider index cost. We generally calculate profit how? Sale minus cost. Correct? Net of tax book gains will be what? 60. 70 minus 10. Right? So this will be my book gains. My 9B is 50. My book gain is net of tax 60. Clear? Now, this book gain will be credited to both the partners A and B, 30 and 30. Both are equal in share, right? Clear? Now, as far as 45.4 is concerned, what will be my 45.4? 45.4 will be 80 minus 50, 30. 80 minus 50 equal to 30. Now what circular says is, the circular will say that step up, the circular is providing step up. This is my C minus D. So, sorry. So circular is providing me that provides that step up the capital balance. So 8AB and 48.3 is not giving you any benefit, but circular number 14 is asking you to step up your capital balance by net, or rather let me write it this way, by share of the partner in post-tax book gains. In post-tax book gains, meaning what? it is asking to not consider your 50, but 50 plus 30, this one. So the effect of which will be 80 minus 80 equal to 0. So here there is no double taxation. What will be 48.3 over here? 48.3. 48.3 here as per rule 8AB4 will be 0. Because the capital asset itself is transferred. So therefore the revaluation will, there is no question of revaluating to, attributing to the remaining asset. Because the capital asset itself is getting transferred. And there is no other capital asset or there is no revaluation. So there will be no attribution to this capital asset. Clear? Did you understand this? Clear? Any doubt? Is everybody clear? Say yes or no in the chat box because this is very, very important. Disha, I'm so sorry to hear that, but hopefully this time you could. Don't lose the hope. Clear? This is very, very important. Yes or no, very quickly in the chat box. Yes or no? Do you want me to repeat once again? Bomik, we will come towards what happens if there's a self-generated goodwill. Yes, Jacob, I will repeat how 50 plus 30. So circular says that, Jacob, that 48.3 is not giving you any benefit. 48.3 is not giving you any benefit. So circular is saying, fine, you increase or step up the capital balance. So my capital balance was 50. I have credited this amount to my capital balance 30. So 50 plus 30, 80. So this book gain, post-tax book gain, you reduce it from 80. Clear? Book value of 10. 45.4 says what, Gopika? 45.4 is B plus C minus D. Where is the question of book value there? B is the money received. C is your capital asset value, the FMV of that, and D is the capital balance. So where is the question of book value in 45.4, Gopika? Okay. Disha, you can write an email. Okay. So this is clear, right? So circular number 14 is resolving the difficulty which is arising in terms of the double taxation which is happening. Clear? Now, there is one more example which we'll do. Now, this was the single asset which was transferred. There could be multiple assets. So, another example. Let's take, there are two partners, A, B. My profit sharing ratio is 50-50. Capital is 50 and 50. My assets are X and Y. Now both are capital asset. Both are capital asset. Okay. My book value is 10 and 90. Now both are revalued. FMV is 80 and 120. Now A is retiring, so capital asset X is transferred and money of 15 is paid. Okay, fine. First of all, what is my 9B? You have to tell me. Okay, I'll give you the indexed cost of acquisition. Indexed cost of acquisition is 30. So what is my 9B? Yes, Jacob. So there was no taxable capital gain at the end. Quickly tell me what will be 9B over here? Yes, Jacob, you're correct. So 80 minus the indexed cost 30, my 9B is 50. Right? Let's say my tax is 10. 20%, let's say tax is 10. So my post-tax book gain will be how much? Yes, Gopika. What will be my post-tax book gain? No, Gopika, that's not correct. Post-tax book gain, Jacob, not the only book gain. How 40? How you guys are getting 40? I'm talking about book gain. See, that is the problem which comes when you independently solve the questions vis-a-vis when you see the lectures. So it's not sufficient to just see the lectures, but solve by yourself even when you have seen the lectures. Lectures are just to make you understand. But at the end, if you would not practice, it's not possible. Yes, Jacob, correct. So whatever you are doing, solve everything every time you're doing it in a way that you're solving it for the first time. Also write what is the time you have taken to solve a particular question. What are the mistakes you have made? Write it down on a piece or in a notebook where you're maintaining. So then next time when you are again seeing it, again you just do not see the question and see the answer. You have to solve each and every time whenever you are revising. And also solving doesn't mean that you just do it on Calci or you just do it on, a small chit of paper and just figures. No. When you are practicing, practice as if you are writing for your examination. So that is very, very important. Are we clear? So here, no, Disha, that's not correct. So post-tax book gain will be what? FMV minus the book value and not the indexed cost, because in the books of accounts, we do not take indexation into account, right? As per AS, you do not take indexation, correct? So it is book value, which is 10. So 70 minus, again, tax amount, which is 10, 60. Post-tax book gain is 60. Yes, Bhomik, Gopika, yes. Are we clear? So post-tax book gain is 60. Now what is my 45.4? What is my 45.4? Also, when you're making notes, see, when I used to make my notes, I used to always write it with different color pens. And now also, if you see, I write it with different color pens. So you have like 2-3 pens which you remember. Red is for very important. Whenever you're making mistakes in the sum, write it with red pen that these are the mistakes you made. Also make a separate notebook for points to remember what points you have to remember from each and every adjustment in the sum. So that's how you're supposed to do it. And DT, at least you are supposed to revise it daily, because otherwise you tend to forget the sections. What is 45.4? is what? B is 15. C is 80. What will be my D? No, Gopika, that's not the correct answer. What is D? That is very, very important. Quickly, this should not take so much time. We have to finish our capital gain. We are not just here to find out 45.4, right? No, Jacob. What will be my D? 50 plus. This will be divided between A and B. 30 and 30. So this 30, you forgot. This 30, all of you forgot. Just now we discussed. So this is going to be 15. Are we clear? Yes, Kopika. Bomik, yes, we need to apportion 60 first. Disha, it's not 30, it's 15. Clear? So all of you did not understand this at the first point. Now are you clear about this? Clear? Now, what will be my 48.3? What will be my 48.3? Let me see. What will be my 48.3? 0, 15, yes, yes, very good, Bomik. So my 48.3 in respect of, or let me write it over here, in respect of capital asset X, 48.3 will be 0 because this asset itself is getting transferred. So as per rule 8 AB4, 48.3 is 0. And now this is the only asset which remains. So therefore entire 15 will be attributed to this. So when capital asset Y will be sold, 15 will be allowed under 48.3. Are we clear? Are we clear? Any doubt? Okay. Now I'm going to take up the questions from the, examples from the circular itself. But before that, let's try and understand this circular provides for two more things. And what are those? Characterization of capital gains. Whether this capital gain is a long-term capital gain or a short-term capital gain. Where does it say? In period of holding, how would you consider the period of holding? How would you decide whether the capital gain is a short-term capital gain or a long-term capital gain? Right? So there is no clarity on that. Again, for that, the circular is giving the guidance. The circular has given the guidance with regard to that. And what is the guidance the circular has given? Let's try and understand. So, here, if you see 45.4 is a formula-based computation, right? And rule 8AA. Rule 8AA, till now what we have done is, we have done rule 8AB. But now I'm taking you to rule 8AA, which is there. That is providing the period of holding guideline. What does it say? Rule 8AA, which is there, not 8AB. Rule 8AA provides for method of determination of period of holding. So, Rule 8AA provides for method of determination of period of holding. And what does it say? It says that the amount, period of holding will not be on the basis of the period for which the specified person was a partner in the entity. See, here under 45.4, it is whose income? It is the income of the partner. The partner is receiving the amount over and above his capital balance. So that is his income, right? Which is chargeable under the head capital gain. Right? So here, technically, there is no way to decide how long a capital asset has been held. Right? Capital asset transfer, that is for the firm under 9B. For that, the normal period of holding will apply. Here we are talking about the period of holding for the taxability under 45.4. So this is not on the basis that for how long a person was partner in the firm. This is on the basis of the capital asset to which the amount taxable under section 45.4 is attributed. So this is on the basis of capital asset to which amount taxable under section 45(4) is attributed. What do we mean by that? So, if the amount chargeable, rule itself provides that if the amount, let me copy the rule for you so that see, if the amount or part of it shall be deemed to be from the transfer of a short-term capital asset. Sorry, this is not copied properly. 1 second. Yeah. So, first is capital asset, which is short-term capital asset at the time of taxation under 45(4), or if the capital asset forming part of the block of asset, which is a depreciable asset. And the C is if it is a capital asset being a self-generated asset and self-generated goodwill, then it will be deemed to be the transfer from short-term capital asset. So if these three are there, in case of these three, short-term capital asset. And if the amount is attributed to a capital asset which is not covered in this and is a long-term capital asset, so this is first. If amount attributed to capital asset not covered in one and is long-term capital asset, then it will be transfer from long-term capital asset. I'm sure you have not understood it very well, right? But let me explain it in a proper manner so that you are able to clearly understand it with the help of the example. So let me give you an example. So let's say in this particular case, if the asset which is transferred, we are not looking into that. What we are looking into is that to asset to which the amount is attributed. The asset to which the amount is attributed. So for the characterization, if you see, we are not looking into the characterization of the capital asset which is given, because the money could have been given, the amount could have been given through a capital asset, but what we are looking at is the capital asset to which the amount is attributed. So if it is attributed to a short-term capital asset or to a depreciable asset or to a goodwill or self-generated asset, then in that case, it will be considered to be short-term capital, transfer from short-term capital asset. Else, it will be considered as long-term capital asset. So let's say in the example which I had given you, this example. This one, right? Here, I had X and Y as my capital asset. Correct? Now, if my capital asset was X and Y, now under 45(4), 90 was coming. Correct? Now, this 90 which is there, the capital asset to the, the capital gain to the extent of the proportion to this asset will be short-term capital asset. So 30 will be considered as, let's say if this was short-term, so 30 will be short-term. And let's say if Y was long-term, so then 60 will be long-term. So it depends on X and Y, their status or their period of holding. So let's say if this was short-term, if this was long-term, then this will be short-term and this will be long-term. Are we clear? Clear? Here also, Rule 8AB4, one amendment which you will make here is, here we had not considered the circular because at that point in time we were not discussing the circular, but you will make a change over here. Here your 9B was 60. Here I have not given you index cost. So here you should write, in this question I have not given you the index cost, but you will write over here. That is not happening. Here you shall write second, there's some issue. Okay. Okay, here you shall write stepper with post-tax book gains. Here you do not have the availability of index cost, so therefore we have not done anything over here. Clear? Clear? So this is example number to the Rule 8AB4. Here I had not added the index cost because I had not explained to you circular at that time. But if there would have been any index cost, so sorry, not the index cost, sorry, my bad. Here we don't need the index cost. Here just I need tax amount. Let's say tax here is 10. So my post-tax book gains would have been 50, right? So therefore, here I would have added 50, out of which the share would have been 25 and 25. So 50 plus 25, 75, and capital gain under 45 4 would have been 5. Clear? Because that time we did not discuss the circular, so therefore I have not added over here. But now you can make an amendment because we have discussed the circular already. Clear? So I was talking about this example to subrule 3, where the cash is, sorry, not this one, subrule 2, where the cash is paid. So under 45(4), there was capital gain, which was 90. Now, how would you determine what is short term, what is long term? So to the extent of X, it will be short term. If the X is short term, if Y is long term, to the extent of Y, it will be long term. Clear? Are we clear? So the attribution will determine your short term and long term capital asset. Any doubt till now? Any question, any doubt? Any doubt? Okay. Okay. Now I will deal with the examples which are given in the circular. So let's deal with this example. There are 3-4 examples given in the circular. By which you will get a clarity much more. So examples in circular number 14. Okay. So let's say again, there are 3 partners, A, B, C, having the capital of 10 lakhs each. Okay. And having 1/3 share. Okay. Now each partner has a capital of 10 lakh and there are 3 pieces of land. STU. The book value of STU is 10 lakh each. These are my book value. The fair market value. The fair market value is 70 lakh, 70 lakh and 50 lakh. Now, A is exiting and firm decides to give him. A is retiring and firm gives rupees 11 lakh in cash and land due. Okay. Now, what will be my 9B? The indexed cost of acquisition, let's assume it's short term, so there is no indexed cost. Or, okay, if you want to take indexed cost, you can take it up. Indexed cost of acquisition, 15 lakhs. Index cost of acquisition is 15 lakh. So what will be my 9B? Yes, Vomik, Gopika, correct. 9B will be how much? 50 lakhs minus 15 lakhs, which is equal to 35 lakhs. Right? Let's assume tax on long-term capital gain is at the rate of 20%. So this will be 7 lakh. Forget surcharge and cess for now. Okay. What would be my post-tax book profits? What is my post-tax book profit? Yes, Gopika, correct. 33 lakh. How do we get 33 lakh? 50 lakh minus 50 lakh minus 10 lakh, which is 60 lakhs. Oh, sorry, 40 lakh minus 7 lakh tax. 33 lakh. Now this we are going to divide it in 3 partners, credit it to the 3 partners A, B, C, 11 lakh, 11 lakh and 11 lakh, right? What will be my 45.4? Yes, Bomik. Jacob, yes, correct. What will be my 45.4? Yes, Gopika, correct. 45.4 will be how much? 11 lakh plus 50 lakh minus 10 lakh plus 11 lakh. My step up. So this will come to 40 lakhs. Right? Now what will be my 48.3? What will be my 48.3? Yes, Bomik, you are correct. What will be my 48.3? No, Jacob, why 0? It won't be 0. Very good, Gopika. So for you, it will be 0 as per rule 8AB4. And for this, 20 and 20. In the ratio of 1:1. So here, this is revalued by 60 lakh. This is also revalued by 60 lakh. So 60 lakh is to 60 lakh, which is in the ratio of 1:1. So 20 lakh and 20 lakh, this is my 48.3. So now when S will be sold and T will be sold, 20 lakh will be allowed as deduction. Whether this is long-term capital gain or short-term capital gain, consider both of these as long-term capital asset, S and T. So then this will be long-term capital gain. S and T are both long-term capital asset. Clear? Are we clear with this example? Any doubt? Okay. Let me give you one more example. Again from the circular itself. Is this example clear? Okay. Let's say there are three partners, A, B, and C, with 10 lakh each capital. The capital assets are again land, S, T, and U. The book value is 10 lakh. The fair market value is 70 lakh. 70 lakh and 50 lakh. Right? So there are three partners having 1/3 share, 10 lakh capital, and then there are three lands. The book value is 10. Now, let's say A is retiring and the firm is selling the land U. The firm sells land U for or at its fair market value of rupees 50 lakh. Let's assume indexed cost of acquisition is 15 lakh. Index cost of acquisition is 15 lakh. So let's say long-term capital gain will be 50 minus 15 lakh, 35 lakh. Right? The long-term capital gain is 35 lakh. The firm is selling the land itself. Right? The tax on this will be 7 lakh, 20%. Right? So post-tax, book gains are how much? 50 minus 10 lakh minus 7 lakh. 50 minus 10 lakh minus 7 lakh, which is 33 lakh. This is not on account of 9B. Remember, this is not on account of 9B. Firm is just selling the land, right? So here, this will be credited. This is any which way is credited, right? To the partner's account. 11 lakh, 11 lakh, and 11 lakh. A, B, and C. Right? So the capital account of A will become plus 11 lakh, 21 lakh. Now partner A is deciding to exit the firm. Right? And the firm decides to give him on A's exit. Firm decides to give him 61 lakh of money. $61 lakh of money. So what will be my 9B? What is my 9B? Jacob in the ratio of 1:1. 20 lakh in the ratio of 40, where I will divide it equally between S and T in the earlier example. So 20 lakh. 1:1 ratio. Because the revaluation happened in equivalent ratio. Here, what will be 9B? Clear, Jacob? What will be 9B here? Yes, very good, Bombay. Capital asset is not transferred, so 9B is not applicable as cash is given. What will be my 45.4? What will be my 45.4? Yes, Kopika, correct. 45.4 will be 61 lakh minus 21 lakh. 40 lakh. So here instead, if you want to avoid confusion, we can remove this part. You can just remove it, and instead you can make it just 21 lakh, and you can just remove this U altogether. So the confusion will be avoided. Okay, so 45.4 is this. What will be my 48.3? What will be my 48.3? Yes, Kopika, correct. So 48.3 again will be in the ratio of 1:1. So which is 20 lakh and 20 lakh. Because if you see, the revaluation is 60 lakh over here, 60 lakh over here, which is the ratio of 1:1. Clear? Again, let's assume both S and T are long-term capital assets. So gain will be, under 45.4 will be long-term capital gain. Is this example clear? Very simple example, nothing much. Right? Next one is little complicated, which is on goodwill. Let's assume 3 partners A, B, and C with capital of 100 lakhs. Right? And 1/3 share each. There is a piece of land S. Book value is 30 lakh. There is a patent of WDV 45 lakh. Okay. And there is cash of 225 lakh. Okay. The land was acquired more than 2 years ago. So this is a long-term capital asset. The patent was developed or registered 1 year back. Now, A wishes to exit, so they have taken the net asset value. So they have revalued the land and patent based on the valuation report. So the fair market value comes to of land is 45 lakh. Patent is 60 lakh. And then there is self-generated goodwill. There is self-generated goodwill of 30 lakhs. Now A is exiting, so the firm decides rupees 75 lakh in cash and land S to A on his exit. So first of all, what will be my 9B? Let's assume index cost is 45 lakh. Index cost of acquisition of land is 45 lakh. What will be my 9B? Why Gopika not applicable? Jacob, how 30? No, Jacob. How 55, 30? No. Okay. So what is the land's FMV? 45 lakh. What is the index cost? 45 lakh. So 9B is 0. Simple. Or let me just make it index cost. Let's say I will make it 30 lakh. So then in that case, 45 minus 30, 15 lakh. If I've given 45 minus 45, it's 0. How 55 and 30 lakh? Bomik, how 45 lakhs? 45 lakh minus 0, right? Oh, sorry, 45 minus 45, it was 0. So 9B, the calculation is simple. FMV minus the index cost of acquisition. Is this clear, guys? 9B is very simple. Clear? What will be here my 45 book profit after tax? What will be my post-tax book profits? Post-tax books profit. This will be long-term capital asset only. Sorry, long-term capital gain only. Because land is long-term. 9B, we do not apply Rule 8AA. We only apply Rule 8AA to 45(4). Yes, Jacob, correct. 15. So, 45 lakh minus 30 lakh. And if there is no tax, here I've taken 15 lakh, but let's say if it was 45 only, or let's assume tax at the rate 20%, let's assume 3, right? So 45 minus 30 minus 3 lakh, how much it will be? 10, 15 minus 3, 12 lakh, right? 15 minus 3, 12. Or if I'm just taking it here, 45 lakhs only, what you guys have taken up already. So then, because the circular says 45 lakhs, so I've just taken that example only. So this was coming to 0. So my book gain would have been 45 minus 30 lakh, directly 15 lakh. Tax is also 0. Right? Now I'll divide it into 3, A, B, C, and this will be 5 lakh each. What is my 45(4)? What is my 45(4)? Yes, Jacob, correct. It's 15 lakh. So I have received 75 lakh plus land of 45 lakh, right? Minus 100 lakhs plus 15 lakh. Sorry, 5 lakh, not 15 lakh, 5 lakh. So which gives me 15 lakh as the 45(4). What will be 48(3)? Now 48(3) will be what? Yes, Gopika, correct. 48(3) will be what? Equal but what, Jacob? No, Gopika. No, Jacob, not 7.5, not 15, Gopika. Okay. So 48(3) here, how much is the revaluation in patent? Here, there will be no 48(3), correct? This is as per Rule 8AB(4). Here, the revaluation is to the extent of 15 lakh. Here, the revaluation is extent of 30 lakh. The goodwill is created. This is not a capital asset, cash. So, in the ratio of 1:2, 15 lakh is to 30 lakh. right? So in the ratio of 1:2. So to the patent, this is 5 lakh, and to the goodwill, this is 10 lakh. So 5 lakh and 10 lakh. Whether this will be long-term capital gain or short-term capital gain, whether this will be long-term capital gain or short-term capital gain, 45(4). 9B is long-term because 9B land was sold. Rule 8AA does not apply to 9B. Jacob, how long-term? Any reason? Yes, Kopika, correct. Short-term. Bomik, yes, short-term. So if you see Rule 8AA, what did I tell you? Rule 8AA says if it's a capital asset, which is a short-term capital asset forming part of block of asset. So patent is a forming part of block of asset because here if you see it was mentioned as WDV. So which means patent is a depreciable asset, right? Patent is any which way is a depreciable asset. And if it is a self-generated goodwill, then it will be deemed to be from transfer of a short-term capital asset. Since both of these, one is the depreciable asset and one is the self-generated goodwill. So, as per Rule 8AA, this will be short-term capital gain. This will be short-term capital gain. Are we clear? Clear, Jacob? Any doubt? Is 45(4), 9B, 48(3), Rule 8AB, Rule 8AA. Is it very, very crystal clear? Is it crystal clear? Yes or no? Will you revise tonight? Or if you're tired, at least early morning tomorrow, I want you to revise this. Clear? Otherwise, you will forget and you will not remember what I said. Yes or no, please write it in the chat box. Very good, Bomik. So Bomik is going to revise tonight. Yes or no? Quickly. You want a break, right? So quickly. I have to cover last one more point. Yes, good, Jacob. Okay. Now, what I'm going to say is, please listen, very, very important thing. This is a self-generated asset. Oh, sorry, this is a depreciable asset. Right? Now, 48(3) applies in a normal computation. 48 normal computation. You forgot. Let's go back to our PGBP chapter. See, this is why I'm telling you, revise your DT daily. You're not remembering. What is the computation of capital gain for depreciable asset? What is the computation of capital gain for a depreciable asset? PGBP. Where is it? Yes. I'm only not finding it. Where is it? Yes, this one. So what did I tell you at that point in time? What was the computation for the depreciable asset? So when the block itself is transferred, block is negative. there is no unit left in the block, or when the sale consideration exceeds the amount of the block, there will be taxability under section 50. Remember? So, section 50 is for the capital gain on sale of depreciable asset, right? So, if block becomes empty, that is, all units are sold, or if sale consideration exceeds WD, then in that case, you have the short-term capital gain under section 50, right? Else, what you do? Else, you reduce from your WDV less money payable, which is your sale consideration. If your WDV, sorry, if your sale consideration is less than WDV, then you reduce it. Reduce the sale consideration from that, and on the balance amount, you charge depreciation. On the balance amount, you charge the depreciation, right? Now, if understand, this is the computation under section 50. This is the computation under section 32. When the sale is happening in the case of depreciable asset. So technically, 48.3 will never come into picture for computation of capital gain on sale of depreciable asset, because the computation is happening in a specific section 50 to which 48 does not apply. Right? So therefore, even 48 will not apply in PGBP, right? Since the computation is either as per section 50 or as under PGBP in section 32. So in order to provide relief, similar relief as for non-depreciable asset, circular number 14 extends the benefit to depreciable asset. And what does it provide? So circular number 14 extends the benefit to the depreciable asset. So it says that this amount which is there will be reduced from sale consideration or from money payable while computing the capital gain. So what does this provide that? So a specific clarification is provided here in this particular circular, that 48 applies only to capital assets which are not forming part of block of assets, right? Because for block of assets, there is section 43 and section 32. And under capital gain, there is section 50. Right? So to remove that difficulty, it provides that 48.3 will also apply to the block of assets. And how that will be done? So it clarifies that in case of the attribution, the attributed amount shall be reduced from the sale consideration when the asset is transferred, and the net value of such consideration shall be considered for reduction from the WDV. Clear? So it will be reduced from the money payable or the sale consideration in both cases. So here, from this money payable, you will reduce amount attributed under section 45(4). Sorry, as per 45(4). This is as per CBDT circular. So let's say I'll give you an example. How will you write it in the exam? So let's say if my sale consideration is greater than WDV, in this case only, let's assume the WDV of patent is 45 lakh, right? So let's assume my sale consideration is 60 lakh. Sale consideration is 60 lakh. So this is greater than 45 lakh. So how will I do? So here, sale consideration equal to 60 lakh minus amount attributed as charged under section 45(4) as per CBDT circular number 14. What is the amount attributed here? 5 lakh, right? Here I had the amount attributed was, what was the amount? 5 lakh, right? This is 5 lakh. So 5 lakh less, so my net sale consideration will be 55 lakh less my WDV 45 lakh, which makes it to 10 lakh. And let's say if my sale consideration would have been, let's say 30 lakh. So sale consideration less than WDV. Assume block is not over, right? Otherwise, you may say that the block has extinguished. So in that case, WDV equal to 45 lakh less money payable 30 lakh minus 5 lakh. Amount attributed as charged under section 45(4) as per CBDT circular, right? So this makes it to 25 lakh. So how much? 20 lakh will be my balance WDV for the purpose of depreciation. Are we clear? Very good, Gopika. Is this clear? Yes or no? Before we take a break, yes or no? Clear. Perfect, Jacob. So let's take a break of 10 minutes and then we get back because this was very, very intense topic. So let's take a small break and then we get back with the balance section. Okay, students, let's move ahead. So we have done with 45.1, 45.1a, 45.2, 45.3, and 45.4. Okay, one more small thing I just wanted to take you back to 45.1a, which I didn't tell you, where there is a small notification which has come up. By now you have forgotten what was 45.1a, isn't it? Sorry, 45.1b. Okay, what was 45.1b? 45.1b was your ULIP. Now, do you remember? Yes. So 45.1b was where the person receives any time during the previous year any amount under a ULIP, which does not qualify for exemption under 1010D because the premium exceeds 2,50,000. So that will be chargeable under the head capital gain. Now, there is a notification which has been issued here. You can write it down. This is the amendment. So CBDT has notified Rule 8AD. Rule 8AD has been notified to compute capital gains on the ULIP. And how do you compute the capital gain? So it says where the amount is received for the first time. Where the amount is received for first time, then the capital gain will be A minus B. What is A? A is the amount received for the first time under the ULIP, including amount allocated by way of bonus. And what is B? B is the premium paid during the term of the ULIP. Premium paid, total premium paid till the date of receipt of the amount. During term of ULIP till date of receipt of amount, right? Amount allocated, including bonus. Including the bonus. Are we clear? So that is one. The second one is where amount is received second time. Then what is the capital gain? C minus T. Now what is C? C is the amount received under the ULIP, which is the second time you receive it, not the first time. So amount received second time. And what is my D? So amount which is A will not be again considered in C. D is the premium paid during the term of ULIP till the date of receipt of the amount as reduced by the B that has already been considered. So D is your total premium during term of ULIP till date of receipt as reduced by B. Clear? So the amount you have considered in B will not be considered in D. Are we clear? Fine. Okay. Now with section 45(5). Capital gain on transfer by way of compulsory acquisition of asset. What is 45(5)? Compulsory acquisition of the asset. So it is possible that the government acquires your asset compulsorily, and therefore, if you remember, under the definition of transfer, there was this specific mention of compulsory acquisition of asset. So capital gain on transfer by way of compulsory acquisition of asset. Right? So in that particular case, there will be capital gain. So this is specifically covered under definition of transfer under section 247. Right? Under section 247. So how do you compute the capital gain? Let's say, for example, let's take an example that I have plot purchased in the year 2001. Amount was, say, 10 lakhs. Land compulsorily acquired, say, in 2006. Agreed value, say, 25 lakhs. Agreed value 25 lakhs. Let's say I received the compensation in two parts. 2008, I received 10 lakh. 2010, I received 15 lakh. I was not happy with the compensation, so I filed dispute and received enhanced compensation. In 2012, 3 lakh. Legal fees incurred, rupees 30,000. Right? So what does 45(5) provides? 45(5) is providing that in case where there is a compulsory acquisition of the land, so the capital gain will be chargeable in which particular year? Will it be chargeable in 2006 or in 2008? So 45(5) says that 45(5) provides that where the capital gain arises from the transfer of a capital asset, then in that particular case, the capital gain with reference to the compensation awarded first time shall be chargeable as the income under the head capital gain of the previous year in which the compensation was first received. In which the compensation was first received. I'll show you the section. See, this is a section. What does it say? Notwithstanding anything contained in subsection 1, meaning it overrides the general charge where the capital gain arises from transfer of a capital asset, being a transfer by way of compulsory acquisition under any law, or transfer the consideration for which was determined or approved by central government or RBI, and the compensation or the consideration for such transfer is enhanced or further enhanced by any court, tribunal, or other authority, meaning it also covers the enhanced compensation, the capital gain shall be dealt in the following manner. Capital gain computed with reference to the compensation first awarded, or as the case may be, consideration determined or approved in the first instance by the central government and the RBI, shall be chargeable under the head capital gains of the previous year in which compensation was first received. So meaning capital gain in the previous year 2008. This will be chargeable in the year 2008. Clear? When I receive the first compensation. Clear? Are we clear? So in the year 2008, what will be my full value of consideration? Will I consider 10 lakh or 15 lakh? Or will I consider 25 lakh? I will consider 25 lakhs. The entire amount. Cost of acquisition, 10 lakh. Period of holding. From 2001 till, what will be my period of holding? What will be my period of holding? What will be the period of holding? So period of holding will be there till it was a capital asset held by me, because it says capital asset held by the person. So here I've held it till 2006, after which it was taken over. So period of holding till 2006. So 45(1) says in the year in which transfer takes place, but 45(5) overrides 45(1). And therefore, here the capital gain, it is saying, will be in the year in 2008. So that there should not be any hardship to the assessee. Because until and unless I have received the compensation, generally compulsory acquisition compensation takes time. So if it is charged in the previous year in which transfer takes place, then I will be put into hardship. So if my land is also taken up, I do not have the money, how will I pay capital gain? So therefore, to remove that hardship, a specific charge is created. But the indexation and the period of holding will stop in 2006 because it is not held after 2006. Are we clear? Then with respect to the enhanced compensation. Enhanced compensation, what does it say? Where any assessment year where the amount by which the compensation is enhanced or further enhanced by court, tribunal, or other authority, shall be deemed to be the income chargeable under the head capital gain of the previous year in which such amount is received by the assessee. So, enhanced compensation in the year 2012. My full value of consideration will be 3 lakhs less expense on transfer, my legal fee 30,000. So net sale consideration 2.5 lakh. Cost of acquisition will be nil. Right? Cost of acquisition will be nil. Period of holding of original asset, which is 2001 to 2006. So period of holding will be of that of the original asset in this particular case. Are we clear? Cost of acquisition shall be taken as nil. Then, if the compensation is reduced, where the capital gain arising from the transfer of capital asset is computed already by taking the compensation or the enhanced compensation, and subsequently such compensation or consideration is reduced by any court, then the assessed capital gain shall be recomputed by taking the compensation so reduced by the court. So recomputation will be made if the compensation is reduced, and how that will be done, how the recomputation will be done, that shall be done by way of rectification by the AO under section 155. That will be done by way of the rectification. Are we clear? Where there is a death of the person whose land was acquired, the enhanced compensation, if it is now received by any other person, then in that case, it will be deemed to be the income of the other person. So, chargeable in the hands of the other person. Clear? Are we clear? So, in case it is a debt, then in that particular case, it will be the taxable in the hands of the other person. Now, here, one very important point. Here, if say, for example, my asset is transferred, right? So, I have transferred the asset in 2006, right? But the taxability is arising in the year 2008. So, therefore, the question arises whether if I have to claim 54 EC, if I put it in bonds, then in that particular case, can I claim the exemption within the period of 2 years from 2006 or from 2008? So 54 EC you can claim from the date of receipt of compensation and not from the date of transfer. Can be claimed from date of receipt of compensation and not from date of transfer. Clear? This is also true for the enhanced compensation. For the interest on the enhanced compensation, say I have received interest on the enhanced compensation, that will be chargeable under the head income from other sources. Are we clear? That will be chargeable under the head income from other sources. Any doubt? Any question? Any doubt? Any doubt? Fine. Any questions? Yes or no? Is it clear? Is this clear? Yes or no at least? Okay. Now there is one judgment in this particular context. In the case of Balakrishnan, right? Balakrishnan, this is a Supreme Court judgment, which is with regard to the receipt of higher compensation after the notification of compulsory acquisition. So the question before the Supreme Court was whether the receipt of the higher compensation after the notification of compulsory acquisition will change the character of a transaction into a voluntary sale. So, understand one thing. Under section 1037, there is an exemption. And what is that exemption? That is for the compulsory acquisition of land. So then you will say, ma'am, what is under 45(5)? So 45(5), yes, compulsory acquisition is taxable, no doubt. But under section 1037, there is a specific exemption where the transfer is by way of compulsory acquisition under any law of the agricultural land. So if it is compulsory acquisition of agri land, then exempt under section 1037. Exempt under section 1037. Right? Now the question before the Supreme Court was that if there is a compulsory acquisition of land, right, but there is the higher compensation which is received after that. So whether it will change the character of the transaction. So in that particular case, whether the character would be that of the voluntary acquisition and not the compulsory acquisition. Because if it is a voluntary acquisition, then in that particular case, the exemption under 1037 will not be given. So the government of Kerala had acquired the property of the assessee, which was compulsorily acquired under the Land Acquisition Act. And the assessee had filed the objections against the compensation. Right? So the compensation, let's say, was fixed at 14 lakh. And the assessee was not acceptable to the compensation awarded. And then some negotiations started between the parties on the amount of compensation. And ultimately, it was agreed between both of them that some 38 lakhs would be given instead of 14 lakh. Sorry. After this amount was agreed upon between the parties, the assessee agreed to execute the deed for the compulsory acquisition. Now the question was whether this negotiation which happened between the assessee and the government, by virtue of which a higher compensation was given to the assessee, whether in that case, this particular higher compensation after the negotiation will alter the character of the compulsory acquisition. So in this particular case, what did the Supreme Court held? The Supreme Court held when the proceedings were initiated under the Land Acquisition Act, even if the compensation is negotiated and fixed, it would be a compulsory acquisition, because how the land is acquired, it is acquired under the Land Acquisition Act. Merely because the compensation is agreed between the parties, the character of the acquisition will not change from compulsory to a voluntary sale. Are we clear? Clear? So this was the judgment of Balakrishnan versus Union of India. So you can write it down. Negotiation of compensation does not alter the character of acquisition from compulsory to voluntary. Clear? Are we clear? Any doubt? Bombing recomputation by way of rectification under 155 means that the AO will pass the rectification order to recompute the sales consideration by reducing the amount. Clear? Fine. Yes or no? Shall we proceed further? Okay. Now, one more important thing over here in case of the compulsory acquisition. So, in case of the compulsory acquisition of the land, there is also a TDS provision, which is under section 194 LA. 194 LA. Payment of compensation on acquisition of the immovable property. So here you can write it down. TDS under section 194 LA, which is, so any person who is paying to resident any compensation or enhanced compensation for the compulsory acquisition, other than of course the agricultural land, shall deduct 10% of the TDS. 10% of the TDS. But TDS will not be applicable if payment less than rupees 2,50,000, 2.5 lakh. Clear? Are we clear? If it is compensation under right to fair compensation, if there is compensation under right to fair compensation and transparency in land acquisition, Rehabilitation and Resettlement Act. If the compensation is received under this particular act, then also it is exempt. Clear? Are we clear? Fine. So see, we are linking the TDS provision here also, because if you go to TDS section or TDS chapter and then you read it in isolation, you will not be able to connect it in the exam. In exam, if you write this point, you will be considered that you know about even the TDS provision. Clear? So your knowledge would be demonstrated therein. Jacob, yes, we were coming on it. So as I said, the TDS is going to be deductive. Clear? Are we clear? Okay. So now 45(5)(a). What is 45(5)(a)? This is in the context of joint development agreement. So what happens is that many a times these developers of the agreement ask for the land from the landowners, and then they develop the property on that land, and then they give the share in that property to the landowners. So this is referred to commonly as joint development agreement. So what happens that in case the taxability is under 45(1), then there will be hardship, because for the reason I will tell you. So therefore we have a specific section which was again a very new, which is a new section itself. So which is under 45(5)(a). So if if you see the definition of transfer under 247, it includes an arrangement or a transaction where the rights are handed over for the immobile property in a part performance of the contract, even though the legal title has not been transferred. Right? So, under these joint development agreements, the transfer takes place in the year in which the owner of the immobile property hands over the immobile property to the developer. So, therefore, the taxability will arise in the hands of the owner in the year in which the possession is handed over to the developer for the development of the project, in spite that he has not yet received the right in the developed property. So this will cause hardship to the landowners, and because of which we have this 45(5)(a). So first try and understand. Let's say there is this owner of land. It can be individual or HUF. Let's say there is a real estate developer. Now, this owner of land transfers the land, or rather, transfers the possession of the land and in consideration, the real estate developer will give share in the developed building plus some monetary consideration. Right? So let's say the transfer of the possession is happening in the year 2005. And let's say the share in the property comes up in 2010. So therefore, if I go by 45(1), then the taxability should have happened in 2005. However, there is a specific section 45(5) which defers the taxability, defers the capital gain till the date of or till the year of receiving the completion certificate. Till the year of receiving the completion certificate. So what does 45(5)(a) says? 45(5)(a) provides that in case there is a joint development. So here the owner is the landowner only, but he gives the rights, he gives the possession to the builder. So therefore 45(5)(a) says that notwithstanding section 45(1), if you can see here, I've written 45(5) here for your reference. So notwithstanding 45(1), it overrides the general charge, overrides 45(1), where the capital gain arises to any assessee being an individual or HUF from the transfer of a capital asset being land or building or both under a specified agreement. So specified agreement means the agreement in which a person owning the land agrees to allow the another person to develop the real estate project in consideration of share in that land or building or in that project. Clear? So where he transfers under the specified agreement, the capital gains shall be chargeable to income tax as income of the previous year in which the certificate of completion for the whole or part of project is issued by the competent authority. So 45(5)(a) defers the capital gain till the previous year in which completion certificate is issued. Are we clear? Till the year in which completion certificate is issued. And then it says, for the purposes of section 48, the stamp duty value on the date of issue of the said certificate of his share, being land or building or both, as increased by the consideration received in the cash, shall be deemed to be the full value of the consideration received or accruing as a result of the transfer. So, what will be my full value of consideration here? Stamp duty value of the share. Stamp duty value of the share in land or building in developed project as on the date of issue of completion certificate plus monetary consideration received. There is a proviso. Proviso means exception. What does the exception say? That the provision of this subsection shall not apply where the assessee transfers his share in the project on or before the date of issue of the certificate of completion. So where the assessee is transferring the share before, let's say, the completion certificate is issued, then in that case, the capital gain will be deemed to be the income of the previous year in which the transfer takes place. And then 45(5) will not apply, the normal provisions of the Act will apply, meaning your full value of consideration then will not be the stamp duty value of share in land or building as on the date of completion certificate. So, here there is an exception. What is the exception? If share in land or building is transferred before the issue of completion certificate, then capital gain under section 45(1), which is taxable in the previous year in which transfer takes place. And your full value of consideration will be stamp duty value only, but as per 50C and not as on the date of issue of completion certificate. Clear? If share in land or building is transferred after issue of completion certificate, then for the cost of acquisition, you will take this amount. Stamp duty value, sorry, stamp duty value or full value of consideration as per section 45(5)(a). Are we clear? Any doubt? Are we clear? Any doubt? If land is acquired by way of will, that will be the cost to the previous owner, Jacob. Clear? Now, in this case also, there is a TDS. There is a TDS under this case as well. Like we had it for compulsory acquisition, here also we have TDS, which is under 194 IC. 194 IC. So there is TDS here under section 194 IC on the cash consideration, on the monetary consideration, and what is the TDS amount? 10%. So under 194 IC, there is TDS at the rate of the 10%. Clear? Are we clear? Okay. Next is section 46, which is liquidation. Section 46 is for the liquidation. Now, what does section 46 provides? Let's try and understand. So, in case there is liquidation, we have done with 45, right? So, 45 entirely is done. Now, we are coming towards the liquidation, which is under 46. Now, what does 46 provide? So, it says that in the hands of the liquidated company, and it also provides in the hands of the shareholder. So, let me write it down for you. There are two parts to it. 46(1), which talks about the company in liquidation, right? So, in case the company which has gone into the liquidation transfers the capital asset to the shareholder, 46(1) says this is not taxable in the hands of company under section 46(1). So where the assets of the company are distributed to the shareholders on its liquidation, such distribution shall not be regarded as transfer by the company for the purposes of section 45. So 46(1) says that it shall not be treated as a transfer. Clear? So if you see, I'm again putting here for your purpose, section 46(1). See why I'm putting the Income Tax Act bare provision, because that will help you, even understanding it practically. So this says, notwithstanding anything contained in section 45, again overriding 45, where the assets of the company are distributed to its shareholder on liquidation, such distribution shall not be regarded as transfer for the purpose of section 45. And 46(2) says that, let me write it here in this way, not regarded as transfer, right? 46(2) says, where a shareholder on the liquidation of a company receives any money or other assets from the company, where a shareholder receives money or other assets, he shall be chargeable to income tax under the held capital gains in respect of the money so received or the market value of the assets on the date of distribution, as reduced by the amount assessed as dividend within 222C. So, and the sum so arrived shall be deemed to be the full value of consideration. So 46(2) provides that, if the capital asset is distributed or money is distributed to the shareholder of the liquidating company. So in this case, what the shareholder is doing is, shareholder is transferring the shares, right? The shares are getting extinguished. So transferring the shares to the liquidating company right? And the liquidating company in turn is giving capital asset or cash. So this is taxable in the hands of shareholder. So capital gain in the hands of shareholder. Full value of consideration is equal to FMV of assets received plus money minus deemed dividend under section 222C. So I have already a provision under section 222C, which is for the deemed dividend. So if I distribute the assets, then it is also considered as deemed dividend to the extent of the accumulated profits of the company. So where the assets are distributed, the portion of the distribution, which is to the extent of the accumulated profit, is to be treated as deemed dividend under section 222C. So if I'm taxing it under 222C, I will reduce it under the capital gain so that there is no double taxation. Are we clear? So there is 46(2) here plus deemed dividend under section 222C to the extent of accumulated profits, and therefore I'm reducing here. Are we clear? Now, what will be the period of holding over here? What will be the period of holding in this case for the shareholders? So the period of holding will be till the date of the commencement of liquidation. Date of commencement of the liquidation. Are we clear? Date of the commencement of the liquidation. 1 second. So period of holding here will be from date of purchase of shares till date of commencement of liquidation. Clear? Now, if I transfer the assets later on, if I transfer these assets which I have received, so transfer of assets received in liquidation, what will be my cost of acquisition? So cost of acquisition will be the FVC taxed under section 46(2). So when I'm selling off the assets subsequently, then in that particular case, my cost of acquisition will be the FVC tax under section 46(2). Are we clear? Any doubt? Yes, Jacob TDS in 45(5)(a) case has to be deducted by the real estate developer. Assessee is receiving it, right? The landowner is receiving it. How will you deduct TDS? TDS has to be deducted by the payer, who is the real estate developer. Clear? Any doubt? Shall we move on to the next part? Okay. Next is section 46(a). Buyback of shares. Buyback of shares under section 46(a). So, if the company buybacks the shares, right? If the company buybacks the shares, then in that particular case, there is a taxability which happens under the 46A, right? Also, one more thing under this thing, liquidation, I forgot to tell you one more thing. Here, you have to also remember the taxability. Here, this capital gain which will be arising here, either it will be taxable because you're transferring your shares. So depending on whether it is listed or unlisted, it will be under section 112A or 112 for long term or 118AA for short term. Because here what you're transferring, your asset is share. So your capital gain here will be taxable under 112A or 112 or 111. Are we clear? Any doubt? One second, I think there's some issue. Yeah. Okay. So in case you are transferring the shares, then it will be under 112 long term. If it's a listed, then 112A. If it's unlisted, then 112. And in case of short term listed, it will be under 111A. Clear? Okay. Now 46A, as I said, is for the buyback of shares or other securities. So in case of buyback of shares by the domestic companies, buyback of shares by the domestic company, by the domestic company, then in the hands of the company, there is additional income tax or the buyback tax at the rate of 23.296%. 23.296%. This is under section 115QA. And in the hands of the shareholder, the amount is exempt. The income is exempt under section 1034A. Right? So in case of buyback of shares listed or unlisted by the domestic companies, then the additional income tax of 23.296%, 20% plus 12% surcharge and cess is levied in the hands of the company under 115QA. Are we clear? So this is listed or unlisted. Then in case buyback of shares by a company other than domestic company. So buyback of shares or security or any other security by any other company other than domestic company, or if it is a buyback of employee stock options, or if it is a buyback of specified securities which are these employee stock option, or buyback of ESOPs by any company, domestic or any other, right? Then in that particular case, that is chargeable under 46A. So that is not taxable in the hands of company. The income is taxable under the head capital gain in the hands of shareholder. Are we clear? So that is taxable in the hands of the shareholder. If it is listed and unlisted shares, then it is taxable in the hands of company in the form of buyback tax. If it is the specified securities which is ESOPs, or if it is by other than the domestic company where the shareholder receives any consideration for the buyback, then it will be taxable in the hands of the shareholder. Are we clear? And how will you compute it? So the computation here will be the consideration received minus the cost of acquisition. Are we clear? So that is your 46A. Okay. That is your 46A. Any doubt till now? Okay. Now I'm turning towards the different shares and securities, or different instruments and intangibles. Okay. So before that, understand one thing very carefully. We are moving towards the capital gain on various instruments and intangibles. Okay. So first of all, let's talk about the conversion of the debt to equity. Conversion of the debentures into equity shares. Conversion of the debentures to equity shares. So if you are converting the debentures to the equity shares, then in that particular case, whether first of all it will be considered as transfer. So yes, this is considered as transfer because this is as it is exchange. So this is transfer under section 247 because this is exchange. All right. So when you're converting debt to the equity shares, or sorry, debentures to the equity share, this is considered, or this is itself regarded as transfer because this is an exchange. Clear? Now, what will be my cost? Or let me write it, cost of acquisition. What will be my cost of acquisition? So for that, we have section 49(2)(a). It says the cost of acquisition of the shares acquired on the conversion will be the cost of the debentures. So cost of shares will be equal to the cost of debentures. Are we clear? What will be my period of holding? So period of holding is given under Rule 8AA. We just now discussed Rule 8AA. Where? Where did we discuss the Rule 8AA? Where did you discuss just now Rule 8AA? Just now, few minutes back, before the break, we were discussing Rule 8AA. What was that for? Quickly tell me. You shouldn't be forgetting that. What was Rule 8AA? Very quickly. Let me see. Yes. Bomik, it was not for only self-generated goodwill. It was for determining the period of holding for the 45(4) asset. even for debentures, equity shares converted from debentures, that is, for that also period of holding is given under Rule 8AA. It says that the period of holding of shares will include period of holding of debentures. So period of holding of the shares will include the period of holding of the debentures. Clear? Next is conversion of preference shares to equity shares. Conversion of preference shares to equity shares. So again, conversion of preference shares to equity share, this is transfer under section 247, as this is exchange. What will be the cost of acquisition? So cost of acquisition is under section 49(1). So whenever you have cost of acquisition given under section 49(1), understand one thing very carefully. 49(1), which is there, is for the cost to the previous owner or mostly the cost of the previous asset. So section 49, where the capital asset becomes the property of the assessee by way of the conversion of debenture, in that particular case, 49(1) says that the cost of the preference shares will be the cost of the equity shares. So cost under section 49(1) will be cost of the preference shares. So cost of acquisition of equity shares will be cost of preference shares. Are we clear? Then, secondly, the period of holding. Period of holding is as per explanation to section 1 to section 242A, which provides for clubbing of period of holding. Clubbing of period of holding. So here you will club period of holding of the preference shares for determining period of holding of equity shares. Okay. Now, since this is, both of these are transfer, because as it is an exchange, right? But understand one thing. Under section 47, there are transactions which are not considered as transfer. So here, this is specifically not regarded as transfer under section 47(10). So though it is exchange and it should be treated as transfer, but it is not taxable under section 47(10). Similarly, even this is exchange, but this is also not regarded as transfer under section 47. So understand a general principle, which is most of the time applicable, that transactions, when they are not regarded as transfer under section 47, then cost of acquisition is under 49(1), which is the cost to the earlier asset or owner right? Cost of the earlier asset or owner. Period of holding is to be clubbed mostly under explanation 1 to section 242A. For indexation, indexation will be from which year? From the year in which you hold the asset or from the year in which the previous owner or the previous asset was held. So there is a Bombay High Court ruling in Manjula Shah, wherein it was held that period of holding, or sorry, indexation will be from period asset held by previous owner. Are we clear? So for indexation, we have this Bombay High Court ruling in the case of the Manjula Shah. Are we clear? Any doubt? Any doubt? Clear? Any questions? Any doubt? Okay. Next is redemption of preference shares. Right, redemption of preference shares and redemption of bonds and redemption of share capital. So we are going to consider three things. So redemption of the preference shares. Redemption of the preference shares, it is considered as transfer. So redemption of the preference share is considered as transfer. You can write down. Redemption of preference shares transfer under section 247 Anarkali Sarabhai case. Then reduction of share capital. This is also transfer under section 247 as it is extinguishment of rights. Kartikeya Sarabhai. Then redemption of bonds. This is also transfer under section 247 for the same logic that there is extinguishment of the right and also a relinquishment of a right in the asset in lieu of which the assessee is receiving the cash. Clear? This is Pervich Weng Chuk Basi decision. Clear? Are we clear? Okay. Next is sovereign gold bond scheme. Sovereign gold bond scheme. So here, in case any redemption of sovereign gold bond not transfer under section 47, not regarded as transfer under section 47, right? There are two schemes, SGB scheme of 2015 and gold monetization scheme. So interest on SGB is taxable. Interest on gold monetization scheme is exempt under section 10(15)(6). This is a capital asset, SGB. This is not a capital asset. This falls under exclusion. Capital gain on redemption, not transfer under section 47(7)(c). This is not a capital asset, so not taxable. Transfer, if you transfer, if it is not redeemed, but if it is transferred, then it is taxable. This is not taxable. Clear? Are we clear? Are we clear? Any doubt? Are we clear? Okay. Okay, we'll cover a few more transactions and then we will close the session. So next is rupee denominated bonds. Rupee denominated bonds. So transfer of rupee denominated bonds outside India by one non-resident to another non-resident not regarded as transfer under section 47(7)(a). Are we clear? So that is not regarded as transfer under 47(7)(a). Clear? Also, transfer of rupee denominated bond of an Indian company by a non-resident on a recognized stock exchange located in IFSC, where the consideration is payable in forex, again, this is not regarded as transfer under section 47(7)(a)(b). Clear? That will not be regarded as transfer under 47(7)(a)(b). Then, in case of non-resident, any gains arising on account of appreciation of INR against forex shall be ignored at the time of redemption of rupee denominated bond. Clear? Shall be ignored while computing full value of consideration. Clear? Are we clear? Okay. Then are we clear? Okay. Any doubt? Redemption of preference share, as I said, VOMIC is considered as transfer. It is a transfer. It is a transfer. Okay, last one. Consolidation of plans within scheme of mutual fund. Within the scheme of mutual fund. So usually what happens is these mutual funds, companies consolidate sometimes the plans. There are different plans which you may have with a particular mutual fund company. So any transfer by a unit holder of mutual fund units which are held by him in the consolidating plan of any mutual fund in consideration of the allotment of other units, right, will not be regarded as transfer. So not regarded as transfer. So cost of acquisition, as I said, this is under 47. Cost of acquisition will be the cost of the consolidated fund. Cost of acquisition in the consolidated fund will be the cost of acquisition of unit in consolidating fund. This is under section 49(1), right? Then the period of holding also, consolidating fund will be clubbed. So the period of holding of the consolidating fund will be clubbed with the period of holding of the consolidated fund as per explanation 1 to section 242A, right? As per explanation 1 to section 242A. So similarly, if it is a segregated portfolio, if instead of one fund, the portfolio is broken down into segregated portfolio, then in the same way it will be considered. So similarly, for segregated fund. So in that case also, period of holding of the main portfolio will be clubbed with the period of holding of the segregated fund. Cost of acquisition, so here you can write period of holding will be clubbed. Cost of acquisition in segregated fund will be amount of units held in total portfolio into net asset value of asset transferred in segregated portfolio to the net asset value of total portfolio. Right? And the cost of acquisition of original fund will be cost of acquisition minus cost of acquisition of segregated funds. Right? So segregated portfolio means the portfolio which is broken up now, right? Are we clear? And consolidation means you will consolidate everything. Jacob, do not worry. Even if it doesn't get completed, we will finish it off before income from other sources. So next class, what we are going to study is balance some of the shares and securities transaction. We are going to finish. Then we are going to start with the reorganization, right? And the computation. So reorganization, we are going to start. This is going to get finished like in 5-10 minutes. Then we are going to start with the reorganization and the computation provision. Computation will quickly get finished, but we will spend much time on the reorganization. So if some of the reorganization remains, we will complete it in the income from other sources class. And then what remains is section 54 series, which will get over very quickly. Are we clear? Any further questions? Okay. So if there are no further questions, we can stop here for today. As I said, do revise either tonight or tomorrow morning, but please revise. Thank you so much.